Welcome to the Energy Desk, a limited series from Mobius Risk Group on the macro and fundamental trends shaping global energy markets. If you like what you hear and you want us to keep this series going, make sure you let us know by following wherever you get your podcasts or dropping a note to amelvin@mobiusriskgroup.com. Let's hop in.
Hey, Alex, good to be with you again in our third installment of some energy market musings. Hey, there's something that you and I were talking about earlier, and I guess before we get started, for those that may have tuned in to the first two episodes, we will be making a concerted effort to be a bit more high level, less numbers without visuals in this format, difficult to follow along, some great feedback we got, and, likely hit on fewer topics each week, have it be more focused, easier to follow along with. And with that, there's something that you had mentioned to me earlier this week that I'd love to hear a little bit more about. And it fits well with the concept of insufficient capacity in all forms in the energy markets around the world. And this was related to some behind the meter generation. You want to fill us in, or I guess recap, and then we'll kind of kick back and forth some ideas on it?
Yeah. So as you said, it's easy to kind of get down the rabbit hole with this stuff. So we'll try and keep them pretty quick. But it's interesting to see, as we talked about last week, this thirst for reliable energy, reliable power rather, especially in this data center AI kind of frenzy that's going on right now, where you have big tech companies who historically have been investing in favor of kind of newer energies like wind, solar, and those types of intermittent resources. But that intermittency poses a problem to data centers. So as we discussed last week, that reliability is kind of the big focus. And so where are they going to get that reliability? Kind of an interesting development this week and all throughout this summer has been seeing how we're really getting interest in the big three, as I am kind of thinking of them. So you have Amazon, who earlier this year was looking at the Talon nuclear, so the Cumulus data center project. So that's 960 megawatts of nuke for Amazon for their data center up in PA. But then this week we had Meta come out with an agreement for 150 megawatts of geothermal with Sage Geosystems. And then we had another report that was, less favorable, but xAI, so Elon Musk's AI company, has been running some gas turbines behind the meter, roughly 100 megawatts of capacity. But as I understand it, that's kind of a transient thing while they await connection to the grid for that extra 100 megawatts that they're currently generating with their own gas turbines. So that's transient. They have some air permit issues that they have to figure out there. But I think it's really a confirmation of what we've been talking about, where this hunt for reliability is going to focus investments in purely those generation resources. So, I don't know if you want to expand on some of that, but I thought that was kind of, it's interesting to see where that takes us, potentially increasing investment in natural gas as well.
Yeah, I think from a high level, those that are exposed to the volatility and have the reliability needs can clearly see the problem and are finding solutions. The prevailing narrative is more and more renewables, and maybe in a subsequent podcast, we'll talk a little bit about the work you've done on what's happened in Germany, really over, say, the past decade, but been expedited recently. And so I honestly just see this, Musk or the xAI data center move is a really clear example of that. I have the capital, there is a problem, and I can and I will solve it. And you see that both in actions with the physical reality on the ground. You also see it in forward markets, where you're getting more and more seasonal volatility, day-to-day volatility, intraday volatility. And I don't think it's going away. I guess to put this topic to bed, the only other thing that I thought was interesting that came out this morning is related to the demand for natural gas fired generation. And by the way, subsequent months would not include Musk's generation in Tennessee, because it would not likely be reported to the EIA. However, the EIA's latest natural gas monthly data with the data being for the reference month of June 2024, came out with yet another record high for monthly power burn. When we say record high, we covered it last week, I think, in maybe more detail than listeners could follow along with, meaning that the power generation or the gas consumption for power generation in the month of June totaled 41.34 BCF per day. And relative to all other June months historically, that is a new record. For context, it compares to another year with the market dealing with excess gas in the ground, 2016, where there was 32.34 BCF a day of generation. So up a comfortable 9 BCF a day from there. And then walking a little further back in the time machine to 2012, another similar year. We've used 2012 and 2016 often this summer as proxies for what we are dealing with in the natural gas market. And in June of 2012, there's 29.33. One might almost wonder if we're making these numbers up. Conveniently, round number changes: 12 to 16 plus 3, 16 to 24 plus 9. So a bit of a parabolic move higher. So maybe as a transition away from the demand side and the gas market, I think we'll finish our time today focused on the supply side. And first, let's stay on this side of the world, move a little further south down into, I guess, what we'll call the Southern Caribbean, and talk a little bit about what's gone on with Guyana and oil production in that small nation in the northern part of South America. You want to give us an update there?
Yeah, so for reader or listeners who are not familiar with what's going on in Guyana, basically they've gone from 0 barrels per day in 2019 all the way up to a peak this June of 670,000 barrels per day. So quickly, Guyana is becoming a major global producer. A lot of that is exported to Europe, but one of the interesting developments this year in Ghana is, one, they brought on the Payara Gold project in November, and that has steadily increased from 0 to basically 250,000 barrels per day. But this summer, one of the notices that Exxon gave was that they're going to be fulfilling their side of the agreement with the Guyanese government to connect a gas pipeline from some of these Liza field projects down to the Wales gas to power project, which is going to be one, generating power with natural gas for Guyana, but also is going to have a gas processing facility. And so as part of that, they have to shut down production on 2 of those facilities in the Liza field. And those vessels, when we look at daily production numbers going from June, which, as I just mentioned, 668,000 barrels per day at the final day of June. Quickly in July, we erased approximately 37% of Guyanese production. So that basically dropped it down to an average in July of around 423,000 barrels per day. And the final week of that is up to basically 456. So all that to say, we definitely did see the impact of that work that they're doing to connect the pipelines. That is transient. And so, I expect that to be already back to where they were producing in June, given the 2-week notice for each of those 2 vessels that they had to connect to. But, going back to this U.S., crude import from Guyana and how Guyanese...
Hang on, let me interrupt you for just a second there, Alex. Just as a recap. When we go back, this is not the first time they've had a major infrastructure project take oil production down, with the ultimate impact being we are refining our process. We're bringing on new portions of the field. So is it right to say that we would expect Guyanese oil production to begin accelerating again here in the near term?
I do. Yeah, I do think that that's the case. I expect it to be resolved, at least back to where they were in June, potentially already. But as we look forward, they have 3 projects that are going to be coming online by 2027. So that's going to take Guyanese output basically over 1.2 million barrels per day. And the interesting thing when we separate each of the grades that Guyana is producing, I think that's one of the more interesting trends to follow, where this latest project, the Payara Gold grade that they're producing with the Prosperity floating vessel, that one is a heavier grade than their 2 from the Liza field. And so prior to starting that project in November, the vast majority of Guyanese barrels, when we look at vessel tracking and things like that, we're heading to Europe. And so when that new grade came online, it was interesting to really look at the trend in U.S. imports from Guyana. We had basically a step change that really reflects the U.S. preferred grade, which is that heavier end of the spectrum. So the Power Gold 28-degree API. So it's definitely on the kind of the middle heavy, medium heavy end of the spectrum. Whereas the Lisa Field grades, you have the Unity Gold, which is 34.5. So it's more of a lighter grade. And then Lisa, which is 32. So it's kind of right in the middle there. And most of those other barrels for Lisa and Unity Gold were heading to Europe. So I think that that's one, an indication, just confirmation really of the U.S. preferred grade that aligns with kind of the configuration of U.S. refineries, and definitely expect to see, steady demand from the U.S. for Power Gold, which, as I mentioned, is 250,000 barrels per day. As they bring on these new projects, that creates an interesting dynamic to follow. And, as we've discussed really recently, how that fits in relation to OPEC barrels and what's going on with Libya, I think that kind of paints an interesting picture of what we should expect in the next few years. So I'm really curious to hear maybe if you can expand on that.
Yeah, some fun thoughts from Libya this week, and just kind of finishing on the topic of Guyanese barrels making their way into the U.S. While we've yet to see the Dos Bocas refinery in Mexico really ramp up as they had intended, that would be Mexican heavy barrels staying at home, which historically have been imported to the U.S. while we turn around and send them back our products. So it looks like we're just finding a new partner in the neighborhood. Not necessarily a partner in any way. And on the other side of the world, certainly some interesting news from Libya. So, the headlines are that the Eastern Libyan government run by Khalifa Haftar, or the head of the Libyan National Army, has been in this rift with the internationally recognized Tripoli-based government. And I am going to butcher the name. I'm going to make an attempt at it. Abdul Hamid Dibeiba. And the riff is about the central bank, who controls the central bank, and thus who controls the flow of oil revenue. So Libya's got a long history now, well over a decade, of turmoil that has, obviously had far greater humanitarian impacts than it has impacts to oil markets. But in many countries in the Middle East, and certainly all OPEC members, so goes oil revenue, so goes some of the humanitarian issues that a country faces. While we should not be driven by dollars, the simple fact is we need them to feed ourselves, power our homes. So Libyan production, as it stands today, or so reports go, 700,000 barrels a day of their 1.15 million barrels per day of production is offline. For context, I'm going to say 80 to 90% of Libyan production is produced in the eastern half of the country, that controlled by Haftar. And in the west,
so real quick, is that eastern or in the southwestern?
So most of the production is in the eastern half of the country, thus why the Benghazi-backed or the Benghazi-based LNA government has been able to take such a swift action. They control the barrels. Now, some of the refining and exports will move out of the west. However, there's clearly a conflict that is going to impact the flow of Libyan barrels for some unknown period. So back in our time machine a little bit. Before the Arab Spring uprising in 2011, Libya was producing 1.5, 1.6 million barrels a day. Immediately after the assassination, well, actually before the assassination of Gaddafi, but leading up to what was clearly a rapidly escalating, I guess best defined, civil war in Libya, production began to fall. Bottomed at near zero in late 2011. There was a rebound after Gaddafi's execution, and we made it back to, 1.5 million barrels a day. And then we spent a prolonged period, let's just say 2013 to 2017, doesn't line up perfectly with the calendar year. But in that period, Libyan production most often hovered around 500,000 barrels a day. So ongoing civil war, unrest, militant groups and warring factions, all over the country, impacting the, normal operating conditions of the oil industry. And There's even been some influences by other OPEC members, both in that time and up to present, with the UAE recently taking a more active role in supporting the the Eastern-based LNA government. So where are we today? We've been running around 1.15 million barrels a day of production. We're proposed to be down around 400,000 barrels a day. Lo and behold, right back to where we were at the time that we were at the peak of the civil unrest. So where do we go from here? I think it's certainly an unknown how long this will last. In one hand, if both sides could come to the table and decide that they could all play fair as it relates to central bank control, we'd see those barrels come back quickly. But in the meantime, we are poised to get more OPEC overall barrels on the market. One would likely think that would be some from the Saudis, possibly even more from the Libyan friend, the UAE, which has actually been one of the more consistent and running near peak level OPEC members in the past several months. And I think the clear takeaway would be that even at current levels, the Saudis could offset that when one fell swoop. In the next few days, we'll get a look at what production was for the month of August from OPEC members. And the headlines this week, I think along the same lines of lost supply from Libya, have been contributed to by yet more promises from Iraq, Kazakhstan, and Russia that non-compliance or overproduction through the summer months would be made up for this fall. So
right. More of the same from the spring.
Yeah. So we lose Libya. We're going to lose some from Iraq. We're going to lose some from Russia. We're going to lose some from Kazakhstan. Those are all the storylines. That's what helped drive the market higher this week. And yet the Saudis on their own could make up for every barrel of lost supply. So you kind of put all these pieces of the puzzle together. What you covered well with Guyanese production, and what we see is a path forward from the Middle East, meaning pluses and minuses from varying members, but the world may not really be short any barrels for any extended period. In fact, could even be higher, because the Libyan issue could be resolved in a matter of days, hours. And on one hand, and I'll proudly wear the badge of chief conspiracy theorist at Mobius, but curious to really reflect on just some of the key players in the puzzle. And you really contemplate whether we're fast tracking towards another OPEC, Western nation, really just OPEC US shale price war. Mm-hmm. OPEC's been policing the market for the better part of 2 years now. The SPR has been slowly refilled, and there have been promises made that refill rates would step up if prices got low enough. Well, how long will OPEC and its member states, certainly the Saudis, sit on the sidelines and police the market and help everybody do better, while the U.S. is somewhat hamstrung by the fact that we can't really export more barrels right now? So in any price environment, would it make sense that an OPEC member state, or even a non-OPEC, non-North American producing country, sit idly by while waiting for the U.S. to get its next slug of meaningful export capacity, which, as it stands right now, looks like it's really just a seaport terminal? Would the rest of the world wait idly by for the U.S. to deliver another 1 million barrels a day of production into a market where clearly that's its only outlet? Interesting data point, which I think should be pretty well known. I just don't see it covered very often. Effectively, every incremental barrel of U.S. production since 2014, when we first began exporting, has gone to global markets. Right. I think there's a 300,000 barrel delta. And, I think that's some interesting context too when it comes to the possibilities for a price war. What does the executive branch in the U.S. do if the Saudis and OPEC begins meaningfully ramping up production? And of course, it's at a fun time where, who is the U.S. executive branch? We've got a sitting president who is here in the final hours said, nope, it's not going to be me for re-election. We've got a Democratic Party nominee who has made some pretty vitriolic, I think maybe I'm making up a word there, but I'm going with it, comments about the U.S. E&P community and her views on whether we should or should not support them. On the other side, you've got a former president trying to take another run at it, who, I think is a bit of a misnomer, has been given credit for low energy prices when really low energy prices in the U.S. or North America as a whole were really kicked off by the OPEC U.S. shale price war. Mother Nature chips in plenty as well. So interesting times. I think we're in the hold your breath and see what happens next. Our bet, or well, not fair to say our bet, I'll put my name on this one. My bet would be that you add up all of the negatives, 700,000 barrels a day from Libya, Iraq saying they may cut as much as 150, a couple hundred, chipped in a little bit from Russia and Kazakhstan, and you could convince yourself that you could lose 1.25 to 1.5 million barrels a day of global supply. Personal view, I'd cut that in half, and that would be my most aggressive stance for any sustained period. I would imagine that we find ourselves after the first year of 2025 contemplating what we're going to do with all of the supply that we have, with the only caveat, if I get to put my name on a number, I also get to say why I would be wrong. In the ongoing, Middle Eastern conflict between really Israel and the Palestinians, but obviously then contributed to by Iran-backed militias that have a strong view on Israel's, I guess, kind of conquering mentality. Yeah. So interesting times for sure.
Yeah, it is. Yeah. And I think all of the cuts that you're talking about are supply side risks lean into the transient territory where you're like, okay, so maybe this will happen for, as you said, months or weeks or even, quarters, but it does not seem like something that's going to be, structural. So I think that is offset, as you said, by the OPEC side. I think it's interesting to look at how, M&A activity has kind of unfolded in the U.S. in the last year and a half-ish, the last couple of years, and where commentary about these acquisitions and is really guiding, target marginal cost of extraction. So how can we get our cost of each barrel to be below $40? So I think that is in some ways, to me, at least, an indication of preparing, a little bit of a hedge for, potential OPEC supply coming in without a whole lot of demand to offset what's going on.
Yeah, and I think as a good sign off, I'll leave the cliffhanger for something for us to discuss in future episodes. We have seen numerous producers in the U.S. say that they can produce down to $40 a barrel. Even some that would stop short and say $50 a barrel. I would ask anybody that's listening to this to go back, stick a price chart and put production plotted on that same chart. And you tell me how good we are at producing below $50 a barrel.
Right. And for context, most of OPEC, as of 2021 was below $15 a barrel. So they have way more room to run than the U.S. And so I think that's really the conversation to look at here.
Yeah, and it's a battle of what one needs for today versus what one's reserves are in a much further out tomorrow. I think it's clear that the places in the world that have some of the most prolific reserves have in some ways still been restrained, constrained. Venezuelan potential is remarkable. North America, right. While I think we're no longer in the early innings of the shale game, there's still plenty there. And so it's who goes how fast and why we'll continue to talk about. I think it sets us up for some interesting times. I will sell the idea of quarters, maybe by the ideas of weeks of impact. Mm-hmm. So I think we'll be frequently revisiting the rapid changing outlook on the supply side in really just the next weeks. Right. I don't imagine that we'll have to pause for quarters to have something new and interesting to talk about.
Yeah. Yeah, got some interesting stuff coming this week. So it'll be fun to talk about what's going on with, OPEC's monthly numbers and all of that next Friday.
Thanks, Alex. Good time as always.
All right. Thanks, Zane. Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.